For many livestock farms, feed is not just a cost, it is the cost that decides whether the farm survives. On a typical operation, about 60 to 70 cents of every revenue dollar is spent on feed. When grain rises by as little as 10 cents, profit can disappear before the farmer has time to react. That is the trap. Farmers cannot raise meat prices as fast as their feed bill rises, so the loss hits them first and hardest. In that trap formed, why shocks are hitting more often, and how the pain travels from grain markets to farm bankruptcies to grocery budgets. Start with three scenes. An Indonesian grower has 10,000 birds in a house and a feed truck quote she cannot afford. An American rancher sells breeding females she wanted to keep, because buying hay now means losing money later. A family in a supermarket reaches for chicken, checks the price, and puts it back. Different countries, same chain reaction. When feed spikes, producers cannot pause biology. Animals still eat every day, whether market prices cooperate or not. Cash leaves the farm immediately, while revenue arrives weeks later. That timing mismatch is what turns volatility into insolvency. Since 2005, this system has absorbed 5 major feed cost shocks. Each one came from a different direction, but all of them landed on the same weak point. Each shock looked temporary at first. Together, they changed the baseline and left less room to absorb the next one. The first shock came from policy. In 2007 and 2008, the U.S. Renewable Fuel Standard expanded ethanol demand and pulled corn deeper into the energy economy. As acreage shifted, feed markets lost slack. Baseline feed costs moved to a higher floor, and producers leaned harder on substitutes like DDGS, which means dried distillers' grains with solubles. It also linked feed more tightly to energy cycles. When oil moved sharply, grain economics became more reactive, even before local harvest fundamentals changed. That shift mattered because it changed behavior before the next crisis even arrived. The second shock came from weather. In 2011 and 2012, severe drought damaged major grain regions. At the same time, ethanol mandates still held demand near 12.6 billion gallons, so less of the adjustment happened in fuel, and more of it happened in feed. Corn prices roughly doubled, and many cattle producers liquidated herds to cut losses. Rebuilding breeding herds is slow. The effects lasted years, and beef pricing relationships were reset for nearly a decade. That delay matters. Once breeding stock is culled, recovery follows biology, not quarterly reporting cycles. The third shock came from logistics. In 2020 and 2021, COVID disruptions reduced port throughput and container availability. Grain could exist physically, but moving it became expensive and unreliable. At the same time, China accelerated swine herd rebuilding after African swine fever losses, adding large import demand to an already stressed transport system. So prices rose not only because of supply, they rose because the delivery machine itself was breaking down. This period showed a hard truth. Markets can experience severe price stress even when physical supply exists, if logistics cannot move that supply at scale. The fourth shock came from war. In 2022 and 2023, Russia's invasion of Ukraine disrupted Black Sea routes and trapped about 22 million metric tons of grains and oilseeds. Then, energy amplified the damage. European gas moved above $100 per MMBTU, and around 70% of ammonia production capacity was curtailed. That matters because natural gas is both fuel and feedstock for nitrogen fertilizer. When gas explodes in price, fertilizer follows. Global food price pressure surged. The FAO food price index reached record highs. Other disruptions stacked on top. By April 2025, more than 168 million U.S. birds had tested positive for HPAI, which means highly pathogenic avian influenza. A severe El Niño also hit Peru's anchovy fishery, reducing fish meal output by about 23%. Fish meal prices climbed toward $1,790 per metric ton, raising costs for rations that depend on marine proteins. The fifth shock is still unfolding. From 2024 through 2026, conflict around Hormuz and attacks in the Red Sea disrupted shipping routes and insurance markets. Hormuz alone carries roughly 25% of global seaborne oil and major fertilizer flows, so pressure there spreads quickly into farm economics. Many vessels rerouted around the Cape of Good Hope. Voyage times stretched, fuel burn rose, and war risk premiums increased. Through 2024, war risk insurance often ran around 0.7 to 1.0% of vessel value. So even when Midwest grain prices cooled from 2022 peaks, delivered feed in importing countries stayed painfully expensive. That divergence confused many observers. Export region grain looked cheaper, but importer feed bills stayed elevated because freight, insurance, and route risk carried the real premium. This is why raw commodity charts can mislead. Farmers buy delivered feed, not headlines. Now zoom into the metric that turns market stress into farm-level survival math. FCR. FCR stands for Feed Conversion Ratio. It measures how many kilograms of feed are required to produce 1 kilogram of body weight. Lower FCR means better efficiency. Higher FCR means more feed for the same output. In highly optimized broiler systems, FCR can range from about 1.34 to 1.50. In many field conditions, practical performance is closer to 1.55 to 1.80 because disease pressure, heat stress, and housing quality reduce conversion efficiency. That gap looks small on paper. Financially, it is brutal. Farmers often describe this as hidden drift. You barely notice day-to-day slippage. Then the cycle closes, and the margin is gone. A deterioration of just 0.20 points in FCR can destroy about $0.22 of margin per bird. Across a flock of 10,000 birds, that is roughly $2,200 lost in one production cycle. For a small independent farm, that can erase the entire cycle profit. Break-even math tightens even faster when feed spikes. Under baseline 2026 assumptions, feed near $0.55 per kilogram and live bird prices around $1.28 can still support operations. In that baseline case, break-even FCR sits near 1.69, which many farms can reach. Now apply a moderate shock. Feed rises around 20%, but consumer resistance allows only about 3% improvement in live bird pricing. Break-even FCR falls toward 1.45, below what many farms can sustain consistently. Then apply a severe shock. Feed rises around 50%, while price ceilings or weak demand limit what farmers can charge. Break-even FCR drops near 1.24, a level commercial broiler systems do not normally achieve. At that point, each kilogram sold can carry a loss near $0.58. At those levels, better management cannot solve the equation by itself. Strong genetics and good husbandry help, but they cannot overcome impossible break-even math. That is why this is called a trap. Once chicks are placed, farmers enter a biological timetable of roughly 35 to 40 days. They cannot pause growth, and they cannot stop feeding. Every day requires feed purchases, even when each day deepens losses. If feed rises 10% without matching sales price movement, productivity can drop about 5% as farms ration or downgrade diets. The burden then spreads unevenly across the supply chain. Independent farmers are the most exposed. They buy inputs at market prices and sell live birds into spot markets, so they absorb almost all feed inflation. In previous stress periods, live bird prices fell near $0.95 per kilogram, while production costs sat near $1.15. That spread means every sale destroys cash. When that happens, many farms cut placements in the next cycle to reduce exposure. That protects cash short term, but can destabilize local supply in later months. Timing makes it worse. Many independents finance a cash conversion window of roughly 35 to 50 days before revenue returns. In modeled moderate stress, DSCR, the debt service coverage ratio can fall from around 1.45 to about 0.85. In severe stress, DSCR can fall below 0.20. Below that threshold, default risk becomes systemic, not incidental. Contract growers sit in a different position. In Indonesia, roughly 93% of broiler output operates in contract structures where integrators provide feed, chicks, and veterinary support. Direct feed volatility is lower for those growers, but they face utilization risk when integrators reduce placements or tighten grading. So the risk changes shape rather than disappearing. At the top of the chain, large integrators have stronger defenses. Firms such as CP and JAPFA can reformulate diets, hedge procurement, and pass part of cost increases downstream. Their operating margins have remained in the range of about 4.3 to 10.6%, even during stress periods. That resilience gap is one reason crises often accelerate consolidation. When small farms fail and large firms endure, market share shifts upward. Over time, resilience itself becomes a moat. Firms that survive one shock often enter the next one with more bargaining power. Past the farm gate, consumers see a pattern economists call rockets and feathers. When upstream costs rise, retail prices move up fast. When upstream costs fall, retail prices drift down slowly and partially. This is why shoppers often ask a fair question. If farm costs eased, why is the shelf price still high? In concentrated chains, downward adjustment usually lags upward adjustment. Over 4 decades, estimates suggest about a 75% decline in how commodity relief passes into core inflation. Retail concentration is a major driver of that asymmetry. COVID made this visible in real time. U.S. processing slowdowns cut beef and pork slaughter capacity by about 40%. Beef farm to wholesale spreads expanded around 292%, moving from roughly $89 to about $347 per hundredweight. Pork spreads rose around 388% during the same stress window. Packer margins climbed as farm incomes weakened, showing exactly where bargaining power sat. Structure amplified outcomes. 4 firms controlled about 85% of U.S. steer and heifer slaughter. In concentrated systems, shocks can become transfer mechanisms, not just supply events. For households, the burden is strongly regressive. In countries such as Nigeria, Kenya, and Bangladesh, food often exceeds 50% of household spending. When prices rise, there is little room to substitute because families are already buying the cheapest options. Show this effect. In the UK, between September 2021 and September 2023, the cheapest grocery tier rose about 36.2%, while the premium tier rose about 15.8%. The health consequences are measurable. A 5% increase in real food prices is associated with about a 9% rise in child wasting risk. Severe wasting risk rises about 14% under the same shock. Between 2019 and 2021, the global number of undernourished people increased by roughly 126 million. So food inflation is not only an economics issue. It is also a nutrition and public health shock that compounds existing inequality. By 2026, analysts described a protein paradox. The U.S. cattle herd fell to a 75-year low, a condition that usually supports producer pricing. But margins still weakened because feed and logistics costs rose while consumer demand softened. As Brent approached $150 and freight costs rose about 20% from early 2026 levels, demand destruction intensified. In that setting, feedlot margins were reported near negative $15.42 per head, while packer margins held around $87.48. So what actually reduces risk? Governments and private operators are testing a portfolio of defenses, each with limits. No single intervention can fix the whole system. Infrastructure, risk finance, contract design, and nutrition policy each address different failure points. In Indonesia, Danantara outlined around a $1 billion program to build as many as 30 feed mills in underserved regions. That sits within a broader development mandate, valued near 371 trillion rupiah. Public demand support is another lever. The Free Nutritious Meal Program targets annual absorption near 1.1 million tons of chicken and 700,000 tons of eggs by 2026. That demand floor can cushion producers when household purchasing power weakens. On the private side, feed substitution offers short-term relief. DDGS can displace corn, but effectiveness differs by species, around 0.97 in cattle and around 0.79 in poultry. So substitution lowers cost pressure while potentially reducing performance. Financial hedging can stabilize margins mathematically, but access is uneven. A single corn futures position can require about $1,500 in initial margin, which is often beyond smallholder liquidity. When volatility spikes, margin calls can overwhelm even larger institutions. During the 2008 commodity shock, the U.S. farm credit system raised around $10 billion in debt to meet liquidity demand. Contract redesign is another pathway. Tournament-style poultry contracts can shift feed risk from growers to integrators, but they also cap upside earnings for farmers. Longer term, alternative proteins are developing. Mealworms offer strong amino acid profiles and fit circular input models, though current costs still limit full replacement of soybean meal. None of these tools is a silver bullet. Together, they can reduce volatility, but only if the system is designed for resilience rather than short-term throughput. Resilience is expensive up front, but systemic breakdown is far more expensive later. That means treating volatility as a permanent operating condition, not a rare event. That is the deeper lesson of the past 2 decades. The protein chain is tightly coupled, from gas and fertilizer to shipping lanes, farms, processors, and retail shelves. When one node breaks, stress propagates across the entire network. So the central question is no longer who can maximize peak year profits. The real question is who can survive repeated troughs without collapsing biological capacity, farm livelihoods, and food access for the people least able to absorb the shock.